Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today I've got another stock analysis video. It is important as it pertains to the portfolio that I run on eToro. So we're going to talk today about CROX, the company, what I think it's worth, and how much we will be adding to it in terms of our assets under management. If you haven't already liked and subscribed, I'll greatly appreciate you doing so. It helps the good old-fashioned YouTube algorithm to bump me up and spread the word. If you're new to the channel, I'm a popular investor on eToro, but that's only a hobby, okay? That's just my hobby. What I really like to do is run an arbitrage fund and to do with credit spreads and option premiums. However, today we're going to be talking mainly about eToro and in particular the business of CROX. So CROX. Revenue expected to come in 20% CAGR, so double-digit CAGR for the last 15 years. Okay, so incredible ability to compound and grow the business. Crazy when you look at the type of footwear that they sell. You think, oh God, they're not exactly the most attractive footwear, but it's not what I think that matters. It's what their customers think that matter, and they have absolutely grown like wildfire. With revenue expected to come in end of 22 at 3.4 billion, I don't believe that actually takes into account the revenue from their newest acquisition, DYODD, which we will talk about in a future slide. EBITDA, analysts are saying 944 million. Again, you look at the CAGRs on that, and they have done a fantastic job, not just of growing their top line sales, but also improving their margins. I'm going to talk to that specifically in a future slide. Market cap at time of recording is 4.23 billion. Enterprise value 4.98 billion. That will change upon the acquisition, as it's taking out about 2 billion worth of debt. The price at time of recording is $69.03. 61 million shares outstanding, so very small float. They went through $1 billion in buybacks over the last 12 months, and the return on capital has been over 20% over the last 5 years and double digits for the last 15. So the management really is to be applauded for their performance over the last decade or more. Balance sheet looks good. It is going to be tested with the acquisition, but at the moment we have a net debt to EBITDA ratio of less than 1, which is obviously very, very good. If we look at our Crassus investment formula, we're looking for companies with low debt, a margin of safety, sales growth, strong margins, free cash flow growth, and ideally a history of share buyback. So that's the formula through which I want to run most of the or all of the core positions in the portfolio. We do have some room for speculations or high growth opportunities that are further out the risk curve, some special situations and turnarounds. Okay, we don't have many of them in the portfolio at the moment, but we do use a separate formula for those. But for our mainstay bread and butter value investing businesses, these are the things that we really want to see. Let's look at the price action recently. So over the last year, you've seen the price action take off and then absolutely fall off a cliff there. And the market sentiment is negative around the acquisition of DYODD, which is another very small privately owned footwear manufacturer. We'll talk all about that. And if we take things back a little further, here you can see that kind of grinding decline since around the end of last year. So very interesting. The key points, okay, so it's basically apparel manufacturer, okay, mainly focused on footwear in particular, but they do have t-shirts and accessories and all that other kind of things. They have a patented footwear brand, so they have a competitive moat around their business. Their footwear, as if you've ever seen a pair of Crocs, you'll know, is extremely peculiar. It is unique in the truest sense of the word. Other people may try to copy the look and have cheap knockoffs, but the way in which the material that they use and the way in which they create the interstitial composition of the actual fabric is patented, and it's unique to Crocs. You can tell I'm not a big textile kind of guy, but it is very important to know that they have something special that their customers absolutely love. They lead the industry in profitability. And as I mentioned, the new acquisition has the market spooked. Now, I've been looking at this company for quite a while. There are many other investors on eToro and various places around markets that have been talking about Crocs, and I was resisting talking about it or getting involved because everyone say, oh, you're just getting on the bandwagon, you're copying other people. Well, first of all, that's why they're called copy portfolios. But anyway, I kept an eye on it, and as much as I actually don't want to take a position in this business just because people are going to say, oh, you've changed, you used to be a contrarian, now you're on the bandwagon. No, it's been beaten down so badly, and the quality of the history of the business is so good that I really had to take a look. So here we are. Whatever. Extremely loyal customers who love the uniqueness of the brand. I've spoken about that. Looking to expand more into Europe, Africa, and the Middle East. So they're mainly based in the US for their revenue. We've spoken about that. Double-digit growth for 15 years. If we look at 06 to 21, this is a really important point. So the direct-to-consumer revenue has increased at about 20%, at 27% CAGR compared to 9% for wholesale. I'm going to show you a graph in a minute where you see the trend completely reversing. They started out, and like many brands do, when you have a product, you don't have customers just yet, you need to get awareness. And so one of the best ways to do it is to sell a product such as these shoes wholesale to the stores that already have the traffic coming through. So this is actually kind of a reverse situation to what we find ourselves in with Foot Locker. So for example, if you got a new sneaker, you would try and do as much direct-to-consumer marketing as you could. But if you're an unknown brand, it really helps to get yourself into somewhere like a supermarket, or even better in the case of footwear, somewhere like a Foot Locker, where people who go in there to buy shoes will see your offering and they'll be able to judge it, and you'll be able to get much more awareness, fishing where the fish are, as opposed to constantly trying to get your message after one or two particular fish, if that makes sense. So here, Crocs have already done that, and they've built their own little cult brand. Now they look at the situation and say to themselves, well, why do we need to go to wholesale where we've got to give up a lot more on our margins? This is also what GoPro are starting to do, if you've seen my analysis on GoPro. And so what will start to happen is you will see their margins expand and expand and expand. You've already seen it for Crocs. GoPro, I expect, will be similar, because you're cutting out that middleman essentially, and you can run a very asset-light business in the sense of your marketing, because so much of our marketing now is done digitally. They have the best cash conversion cycle in the industry. They're very good at their marketing. They're very good at turning inventory and marketing into sales. In fact, they're the best in their particular industry. I really love this point. I love it. SG&A has decreased as a percentage of revenue over the last 5 years by almost 20%. So what does that mean? It means that they are able to continue to grow their revenues without spending as much on advertising and admin. Okay, this is a very, very important point. When you become a Crocs customer, let's say, and this applies for any business really, if they've reached you with an ad or a promotion in a wholesale store, and you become a customer, and let's say you love your Crocs, and all of a sudden you're a Crocs buyer for life, well, now they don't need to reach you via advertising. As soon as you want a new pair, you already think, gee, I want another pair of Crocs, or I'm going to buy a present for mum or dad, my aunt, uncle, zebra, whoever you've got, right? And there's no extra marketing spend on getting you to spend more as a consumer. So this is further evidence to support that their consumers are extremely sticky, and that not only do they have consistency of recurring revenue, but the quality of that revenue in terms of becoming free cash is going to increase over time from this double whammy of them being able to look into direct-to-consumer marketing, shaving marketing expenses, and having long-term customers that come back and make repeated purchases. So from an investment thesis, what are we looking at here? So we've got a quality company, okay? Basically any method or metric that I can think of to measure the quality of a company, they perform very well. So they have growth, absolutely. Free cash flow conversion, absolutely. Competitive branding, yes, they do. operating leverage. Yes, they do. And their management has a really good track record. Okay. So quality wise, there's not much I could say. Their balance sheet is fantastic. Yes, it's stretching out a bit now with the acquisition, but if you've seen almost 2 decades now of management performing in these metrics, it gives me a lot of confidence to say that actually I'm willing to back the management. They know what they're doing. They're sticking to their knitting in the sense that they're not going and buying a swimming pool company or something completely absurd and different. They're buying another shoe company that they'll be able to run exactly the same playbook, and with their increased penetration and reach with direct-to-consumer marketing, now instead of just selling one product, they're going to have a lot more, which I think is a very, very smart thing to do. And the more that they can vertically integrate their offering and diversify the types of footwear or apparel that they sell, I think is a very good move. Their share price has been whacked, so I think now is the time to strike. International expansion opportunity through DYODD and also their own organic reach, plus the ability to run the same playbook as I mentioned. We're looking at almost a 10% free cash flow yield on a company that's growing at 20%. So that is a very, very good opportunity and a very, very good valuation for us as investors. M&A synergy, of course, with competent management. As I said, I believe that they can do it. I believe that they can create shareholder value and diversification. Okay, so this is the graph which I mentioned before. So on the green line, you've got your wholesale as a percentage of their revenues. And as you can see, like I mentioned, when you start out, you look how much the direct-to-consumer, the red line here is, it's not even 10% of their sales were done through their own direct advertising. They were relying on these sort of platform or wholesale branding to gain awareness for their particular product offering. And over time, they haven't needed to do that. And they say, well, why are we going to do that? Let's go down here and just advertise directly to consumers, where we are going to control things much better, and we're going to have a much healthier margin. And so as you can see now, the trend is set to reverse. Okay, got to 50-50 in 2020, and last year they were basically at the same level, and I expect that to start to diverge in the opposite direction moving into the future. So this is the reason for the negative sentiment. So we do have to address it. I'm looking at this acquisition, and initially I didn't like it. And the more I thought about it, the more I learned about CROX history, the more I start to come around and think, well, okay, I think that it is possible for them to really create a lot of value here now that I dig a little deeper. I don't like what they paid for it, but that's another story. Let's analyze. So CROX believes that DYODD can become $1 billion brand by 2024. Now that would mean they would have to double their top line with CROX infrastructure and their existing customers. It could be done. I don't know. In other words, it'll have to grow to be worth 25% of CROX's current market cap. Okay, so that they'll be able to grow the new combined co by a factor of 1.25. DYODD EBITDA estimate is around about 180 million, given that it's a private business, so you can't really look at the books, but given management statement, they said they paid for less than 15 times enterprise value to EBITDA valuation. And looking at the revenue, I kind of worked it backwards. So we're talking somewhere around 180 million for private business. Okay, so it's been started by this guy, Alessandro Rossano, who has taken the business probably as far as he can, I'm assuming. And so now his offering is going to be taken over by CROX management that have this ability to scale on a whole nother level. How are they funding it? So 2.05 billion in cash and about 2.8 million in shares, which will be received by Senor Rossano. The debt matures in 2029, so it's not it's not as long in terms of a maturity that I would like to see, but given the amount of cash this company generates, I do believe that they can pay down that debt quite significantly. Once that's taken out of the way, you will see more buybacks and the market will start to go crazy, re-rating the multiples in the shares. We're looking at also taking out another $500 million in their senior revolver. Okay, so they've got a revolving line of credit and they've tapped into that. Personally, I think they should have pushed for a lower cash consideration. basically, I mean, Rosano's done very well, but if he wants to take things to the next level and if he wants to make a heap of cash for his current company, that's great. I think that CROX probably had more leverage to issue shares more for this as an opportunity. Their shareholders probably wouldn't like it, but I think that if you're really committed to longer term, I think why take the balance sheet risk when the company is generating a heap of cash? They could then always buy back shares later rather than throw more debt onto the business. Then again, depending on what they locked in for their interest rates, I think they've got various fixed and floating rates. Maybe it will work out to be better. So I don't think it's a huge deal, but me personally, I've done this before. I've done leverage buyouts, and albeit on a micro scale. And I always look to get that cash cost as low as possible and to actually defer payments so that the cash coming in can start to service that EBITDA. I'm very, very cautious, and I always want to be able to meet my obligations. So with that hat on, I think that they probably should have got a lower valuation or offered Rosano, say, okay, well, fine, we'll give you a valuation, but we'll take care, we'll get the better end of the deal in terms of the terms of the payment. So we'd either stretch out the maturity or we'd have more of that denominated as shares, okay? As well as a private equity, we say an earn-out clause, but maybe performance-based in payment releases. Depends. Obviously, they really wanted the deal, so they see a lot more in it there than I do. And who am I? The CROX management obviously know their business much better than I. $2 billion is half the current enterprise value, so it is a lot. However, if you look at forward net debt to EBITDA, it's expected to still be right on the 3 times, slightly less, and EV to EBITDA will be less than 7 times. So it's not the end of the world by any means. Okay. Looking into the projections, here we have free cash flow, EBITDA, and earnings on a per share basis. We've got conservative multiples. I have looked at the peers, okay, so the sector valuations, looked at the median multiples and taken a little bit off to be conservative. Here are the implied prices, and if you look at an equally weighted average, this is the target price that we're expected to see. And thanks to the market beating the hell out of the stock price, if we were to get a run on the stock up to this expected valuation, that would be over a double, okay? So 2.1 times the upside by the end of 2023. So it's a big ask, but I'd be more interested as long as they're hitting those earnings targets. I'd be happy regardless of what the market multiples were. If we stretch things out a little further, and I do not give any accreted EBITDA here for the acquisition. So again, I've been very conservative, but I haven't accounted for any sort of slower growth or anything like that. I've taken the historic growth and taken maybe 1 percentage point off. And here you can see the terminal multiples that I've used. Here's the expected EBITDA. That'd be a conservative EBITDA. Here's the free cash flow, and the intrinsic value of the two comes in at around $137.41. Meaning, if I wanted to get 20% compounded annual return on this investment, and these numbers are accurate or somewhere near accurate based on these different probabilities, I can pay no more than $137.41 and still receive my required rate of return. The 2/3 margin of safety means if we're getting the business below $90, and again, if you believe that these projections are accurate, they're always an estimate. You can't guarantee them, of course, that you're getting the business at 2/3 of that intrinsic value, okay, or the discounted cash flows. If we buy the price today and we look at things a little differently, let's say we run our base case for EBITDA on a per share basis and then exit at that median multiple, discount it back at the weighted average cost of capital for the company now, and we're looking at an IRR of very healthy, sort of 30%, which is good enough for me. Cash flows out over the next 10 years, same method, just using the free cash flow instead of the EBITDA method. Discounted at the cost of capital, we're looking at high double-digit returns. So obviously very, very good. Okay, so the verdict for me personally, I'm adding it into the fund, and I'm also shorting some put options on the stock in my arbitrage fund. The company has low debt. It will get higher with the acquisition, but it's just within acceptable parameters. I believe that they can service that quite well and really smash it down over the next few years. Margin of safety is there thanks to the price coming off. Sales growth, absolutely. Strong margins, absolutely. Free cash flow, absolutely. We've seen all that. Share buybacks, they have. That's actually a tick. However, I do not expect that for the next few years because the company should be focused on paying down the debt a little bit more first. And they get the debt down to maybe 1 times EBITDA, then I'd be absolutely clamoring for share buybacks, and that would really start to make the stock tend to re-rate. And of course, we do have some dilution in shares as part of the acquisition. So I'm looking for about 3% assets under management. There were apparel's been really beaten up, and I'm looking at a couple of different ones. I wanted to buy the others because everyone was talking about Crocs. I just wanted to be different, but they're not as good, and I've just got to put aside my feelings and go with what I think is the best. There are another couple I'm interested in. Abercrombie and Fitch, I'm less interested in that. I've already bought Foot Locker, so there's an apparel business. Levi Jeans also looks interesting, but I'm not looking to make a move just yet. So 3% allows me a little bit of extra wiggle room if I want to further add to the stock, if it sells off further, or if I want to increase a little bit more to Foot Locker. I'm basically fully positioned in Foot Locker. Or if I decide that apparel just gets smacked down even further and I want to take a small, maybe 1% stake in Levi's, for example, I may do that. Time will tell. Thanks for watching. Again, if you would, please like and subscribe. That would help me out a lot. And if you like this style of investing, jump on the link to eToro and you'll be able to add us to a watch list. Or if you've got funds and you'd like to copy the portfolio and share in the performance, you can also do that. Okay. Very important, guys. As always, disclaimer, I'm not your financial advisor. I don't know anything about you. This is not my advice. This is not, a promise that things will happen. It's just my opinion and what I'm doing personally with my money and the money that I manage. Just because I do it doesn't mean you should, okay? So make sure you make appropriate decisions and take responsibility for the consequences of those decisions. Having said that, I hope you enjoyed the video and I look forward to catching